So, the market has been on an absolutely wild ride, and this recent pullback has everyone asking the same question. Is the AI boom a bubble that's finally about to burst? Today, we're going to break down the analysis and figure out if this is really the end of the party, or maybe, just maybe, it's a breather before the next big move. And wow, what a ride it has been. Between April and the beginning of November, the market was just on fire. I mean, look at these numbers. The S&P 500 shot up 42%, and the Nasdaq 100, it soared an incredible 60%. That's a monster run, plain and simple. But no party lasts forever, right? After a run like that, you've got to expect a cool down. With stocks pulling back, the question on everyone's mind is pretty simple. Is this it? Is the AI party finally coming to an end? To answer that, we really need to get some clarity. So let's start with a little reality check on what's actually happening with this sell-off. While the analysis we're digging into is pretty clear here, this doesn't look like a bubble bursting. It's not the end of the bull market. Instead, it's what pros call a garden variety correction. Think of it like a marathon runner just taking a quick water break. It's not the end of the race. It's just a totally normal, even healthy pause. Okay, so if this isn't the big AI bubble finally popping, what's the real reason for this downturn? Well, according to this analysis, it all comes down to one word: liquidity. So what exactly is market liquidity? You can think of it as the amount of cash sloshing around in the financial system. It's what makes it easy to buy and sell stuff. Honestly, it's the fuel that makes the whole market engine go. And this slide, it just nails the concept perfectly. When there's a ton of liquidity, that's the left side, the market has so much fuel that it can rally on pretty much anything. Good news, bad news, doesn't matter. But when that liquidity tightens up, that's the right side, the market gets fragile. Suddenly, even a tiny negative headline can cause a sell-off. And that is exactly what just happened. After the last Fed meeting, Jerome Powell basically signaled, hey, we're going to be a little more patient with these rate cuts. The market, which had been expecting a cut in December, suddenly had to rethink everything. That change in expectations effectively sucked some of that fuel, that liquidity, right out of the system, and that's what made stocks so vulnerable. But here's the crucial part. The thinking is that this is temporary. See, the Fed has already ended its quantitative tightening program, which was a policy specifically designed to reduce liquidity. With that over, the long-term trend is pointing back towards more cash flowing into the system, not less. Okay, let's talk about the big, scary B word, bubble. Everybody's throwing it around, so let's get into it. What do the actual numbers say? Naturally, everyone points to NVIDIA. It's the poster child for the AI boom, right? And yeah, trading at roughly 41 times its future earnings, that's a steep price tag, for sure. But you gotta have some context. As you can see here, the wider S&P 500 is sitting at around 22.4 times forward earnings. And the tech-heavy Nasdaq 100 is at 27.6 times. So the question isn't just, is NVIDIA high? The real question is, how high are these numbers compared to, say, history? And this is where it gets really interesting. When you put these numbers right next to their long-term historical averages, yeah, they're a little elevated. But are we in that crazy, off-the-charts dot-com era bubble territory? Honestly, the numbers just don't back that up. Not even close. In fact, this analysis argues the complete opposite is on the horizon. It suggests we're not heading for a pop, we're heading for a flood, a massive wave of liquidity. Let's look at the three big engines that are supposed to drive this. The analysis calls it a tidal wave of liquidity, and it's coming from three huge engines all revving up at the same time. First, you've got the insane capital spending on AI that's not slowing down. Second, massive government fiscal spending. And third, the eventual return of monetary stimulus from the Fed. You put those three together, that's a powerful cocktail for the market. Okay, so with all that in mind, what's the game plan? How do you even think about navigating a market like this one? Let's talk about the path forward. A really clear divide is starting to emerge in this pullback. On one side, you see the super speculative stuff, things like quantum computing and crypto miners. They're getting hammered. But on the other side, the solid defensive sectors and resilient big dogs like Apple and Alphabet, they're holding their ground pretty well. So what does this tell us about where the next leaders might come from? Well, the analysis points to two key areas. First, the big AI players themselves, the ones with real, durable demand. But then there's this other really interesting group called the AI implementers. Now, these aren't just tech companies. They could be in any industry, but they're the ones smartly using AI to get more efficient and boost their bottom line. So the big takeaway here really isn't to run for the hills. It's actually the opposite. The core argument, as this quote puts it, is that this whole pullback is likely just setting the stage for the market's next leg higher. Which leaves us with one last thought. With the core drivers of this market, liquidity and AI, still very much intact, maybe the question isn't if the bull market is over. Maybe the better question we should all be asking ourselves is, where will the next phase of leadership come from?